Welcome to the Financial Feast podcast. I'm Kevin.
And I'm Zach.
And today we're going to be talking about 4 common questions that people ask around the tax season that will help with taxes. Well, before we get into taxes, I always have to ask. So taxes is obviously a really fun topic to talk about.
It's so fun.
But what did you cook this last week?
Yeah, so I am man enough to admit that my cooking didn't go well this week.
Oh, no.
I'm trying to be very successful, and we tried to come up with an interesting thing to do. So we cooked garlic knots.
Yeah.
And they weren't very garlicky. And they weren't knots. So we ended up doing essentially like breadsticks. And they were fine, but they were like more like crackery. They didn't like puff up. We were having a really hard time like twisting them into the knot shape.
Yeah.
So then I was just like, whatever, we're just going to do the stick. And then I was like supposed to put garlic and oil and herbs and everything into a pan and heat it up and then brush it on. And I did all that. And then when we tasted it, it had no flavor at all. So
oh, no.
I don't know what I did, but it was okay.
Yeah. So not the success of the last one then.
Not the best one. So hopefully next podcast we will have something more interesting for you.
Yeah. Well, that's okay. I mean, we can't win them all, right?
Yeah, it's all right.
So when we're talking about taxes and we're kind of getting into this, some questions that some people might have would be, can I do my own, right? So first question.
Or can I do my own taxes?
Yes. Can I do my own taxes? Yes.
Yeah. So I think the question on can I do my own taxes is an obvious yes. I think everybody's pretty much capable of doing their own taxes. I think the other question we really should be asking instead of can I is maybe should I be doing my own taxes? Because there's a lot that goes into doing your taxes. And I think for some people, while you may be able to do it, it just might not be worthwhile putting in the time and the effort to do it. The stress that it may cause you may not be worth the give off of saving a little bit of money to have you do it instead of somebody else do it. So I think it's important to think through maybe do you own a business? And if you do, it's definitely harder to file taxes if you're a business owner. So that might be a reason to not do your own taxes. Are you an organized person just naturally? Are you really good keeping paperwork? If you're not, right, and being able to track all those, maybe it's something that you should not consider doing your own. But if you do want to do your own taxes, there's a number of ways that we do, because I do my own taxes, you do your own taxes.
Yes.
Doing your own taxes is fine. So there are ways that you can do your own taxes if you feel comfortable doing it.
Yes, and actually there's 3 ways we'll talk about real quick. The first one that comes to mind is free file, where if your adjusted gross income, and this is just a specific tax term, which just basically means your income minus a certain tax deduction. But if it's less than a certain limit, you can use free tax software that the IRS has called Free Tax USA on their website. So there you go, free way to file taxes. That's pretty awesome. There's also a couple companies out there that may have a service that'll do it for you.
Yeah, so I actually had a client that I met with recently who works for a large hospital in our area, and he went to his HR talking about filing taxes. He wanted to see if he could save a couple bucks and see if they had anybody they knew that would do it for free. And they actually had somebody that they worked with who would do his taxes for free for him. So that was, I mean, it was worth a couple minutes of asking.
Yeah,
right. And,
for sure.
And your company may not do that, but if you work for a large organization, they may have that as a benefit that they provide you.
Yeah, it's worth asking, right?
Yeah.
Another way that you can do it is an IRS online form. So if your gross income, your adjusted gross income is higher than that limit for the free file, there's an electronic version of paper forms that will do some math for you. But they only give you kind of basic guidance. So once again, this is more if you're comfortable and know what you're doing, I would say. And then another more helpful one that you can do on your own is just tax preparation software. You can pay a fee and use TurboTax, Tax Act. There's a lot of other tax software companies out there, but probably TurboTax and Tax Act are the 2 biggest ones.
Yeah, H&R Block even, right?
Yeah, H&R Block. Yeah. Yep, that's true. They have a good one. You can pay a small fee for that company and use that software. It's a very easy to use software. They guide you pretty well through it. So just know that those 3 options are available to you.
Now, if we do decide to do your own taxes and you feel comfortable doing that, there's a number of steps that we think you could think through on what you should have prepared in order to really be able to confidently do your taxes and then to do them well. So I think first of all, you need to track your income. And when we're talking about income, we're talking any sources of money that's coming in. So this is any rental properties, any real estate that you have, anything you've sold, any investments, interest and jobs that you're getting. This could even be Venmo. I just heard a thing recently that Venmo is now going to be, they already currently do track your spending and they're going to change it in deductions, but they're lowering the number. So you need to now be tracking Venmo if you're paying back family members and things. So those are all important items to follow, is track your income. Number two, there's a couple different important paperworks that you really need to be tracking throughout the year.
Yeah, that could be charitable donations, work expenses, medical bills, student loan documents, investment documents, even mortgage interest documents. Just to hit them real quick, those are some things that you definitely should be aware of. There's also understanding the different income documents that you need, right?
And there's four specific ones that we think that you should look at when you're talking about income documents. Everybody's pretty familiar with the W-2. This is something that you're going to get from your employer around the end of January. I think they're due January 31st. So at the end of January, you're going to be getting a W-2 from your employer, and that's if you're a full-time employee. But in addition to that, there's other income documents that you might have depending on what you're doing. So you might have a 1099, which is simply a freelance or a contract worker. If you own your own business, you're self-employed. A 1099 is just a different form than the W-2, but it's still something that's tracking your income. So if you have a full-time job, you're going to get a W-2, but then you might also have a part-time job. So you can also have a 1099. If you're in college, you can have a 1098T, and this is just something that's going to help you track your expenses and your deductions and your credits for education. And we're going to talk a little bit about that more. And then there's also retirement documents.
Yeah. And when we kind of dive in a little bit about the deductions, right? Kind of understanding what a deduction is, how the deductions work. So the standard deduction for an American is $12,950 if you're single and $25,900 if you're married, right? Those are the 2023 current numbers that we're in. Now, there's different things that you can deduct from, whether it's student loan interest, charitable donations, deductions. This could be if you tithe at a church. Those would be all eligible for that.
Yeah, if you just want to give it to just a various 501c3 company, so a food bank or something even.
Yeah, and most of those places should give you some kind of a proof that you did donate there, or a statement so that you can prove it that you did donate to a charity. Freelance expenses, any work-related expenses that you may have. But most Americans will fall under the standard deduction. And how this kind of works is you can add up all your student loan interest, all your charitable deductions, all your freelance expenses, your mortgage interest, all the stuff that you're allowed to deduct. And if it's less, if you're married, so this, if I'm doing it for me and the standard deduction is $25,900, if it is less than that number, when I add all those other deductions up, then I will take the standard deduction of $25,900. The idea is you want to claim the one that's the highest. So if I added up all that stuff and it was more than that $25,900, I would want to individually list those out, make sure that they're in there, as well as take those.
But realistically, for most people listening to this podcast, we're probably going to be under that number.
Yes.
Right?
Most Americans will.
The vast majority of people. So we're going to list out 4 different deductions that are pretty common that you probably should at least be aware of, that are going to affect you a little bit. But realistically, these are still going to be under that $25,900.
Most likely, yes.
So when we're talking about 4 different common deductions that people usually have, what are ones that you've found?
I would say 4 common ones. Once again, the charitable donations that we had talked about. Mortgage interest. If you have a mortgage, you can write off the interest on that mortgage. Also, freelance expenses and student loan interest if you currently are paying a student loan. Those are the 4 main deductions that you can use right now. There's a few other ones, but I'd say those are the 4 most common.
So we've chatted. So this is all still under question number 1. Can I do my own taxes? We've talked about should you do your own taxes, kind of thinking through those things. We understand that if you want to do your own taxes, then we've talked about 3 different ways to do it with the free ones and the online things. Some different steps that you should do with the tracking your income, making sure that you have the paperwork throughout the year that you understanding what your income documents are, of your W-2, your 1099 and those things. And then now we're talking about understanding different deductions and credits. So Kevin just kind of went over deductions, understanding what those are. There's another thing that is important for you just to quickly understand. It's a tax credit. Tax credits are a little bit different than deductions. Usually tax credits are 1-for-1 when you talk about a benefit for your taxes at the end of the year. So what I mean by that is a deduction. Let's say you are in tax bracket of 22%. If you spend $100, your tax deduction is going to be at that tax bracket that you're in, so $22%. So if I spend $100, my tax deduction is going to be $22 of that $100. So it helps you a little bit, but you shouldn't just be spending money because you want to be getting a deduction. Some people have that mentality, and that's not a great idea in the long run because you're not getting back all the money that you're spending for the deduction.
Right.
With a credit, a lot of times you are. So with a credit, there's 5 different specific credits that we want to talk about. Number 1 is just a saver's credit. And this is something that my wife and I didn't know about for the first couple of years that we were doing taxes. And we ended up learning about this, and this is super beneficial. What this is if you have a retirement account, like a Roth IRA in particular is what I'm thinking of because that's what my wife and I are using it with. If you hit a certain number, and the number changes every year, so I don't know exactly what that number is, but if you do a certain number every year in your Roth IRA, you're going to get a saver's credit back to you. And what that is that just money that they're giving you back for putting money away in retirement. And that's just free money because you're not losing that money that you're putting into your Roth IRA. You're actually saving that essentially like you would in a bank account. You're just letting it grow. But then the government's also giving you free money.
That's pretty cool.
To save that money. So, but that's something that I feel a lot of people just frankly don't know about. So I think that's helpful information.
Yeah, I agree. And part of this is to kind of demystify taxes a little bit, right? Because I think when people think of taxes, there's too much out there. It's too complicated. I don't know where to start. I'm just going to have someone else do it. And just being aware and knowing these things is very good.
Agreed. So there's 4 other really quick credits, and then we're going to get into question number 2. So in addition to saver's credit, there's also an adoption credit. So if you have an adoption, make sure that you're being aware of that. There's an earned income credit. There's a tax child credit, and then there's also a tax independent care credit. So they obviously cover a big gamut, and we didn't want to go too much into detail, but I just wanted to quickly outline what they were so that way you're aware that if maybe you would fall into any of these categories, those are things that you should be aware of.
Yeah, absolutely. And question 2 here, how do the tax brackets work? We're going to explain this as easily as we can because I believe simplicity is key, right?
Yeah, we don't need to, taxes are a little complicated already. We don't need to make this more complicated.
Yeah. So the most important thing to know is that not all money is taxed at the same percentage. So what do I mean by that? What I mean by that is if you were to make $75,000 a year and that puts you into a 22% tax bracket, you do not get $75,000 taxed at 22%. That is not how it works. What would happen is that the first $10,275 of that is taxed at 10%. Then the next $31,500 is taxed at 12%. And then the last $33,000, $225, is taxed at 22%. So what it is it's like a staggered tax rate. And it builds up as you make more money, you go into the next bucket of taxes.
Yes. And this is the case for everybody, right? This isn't just a 22% tax bracket. Right. This is a 24% tax bracket. Yep. This is the 30, whatever, the 31, 37, all these different brackets, right?
Yes.
This is the way that it works. So everybody on their first certain amount of money that you're getting taxed at a certain smaller amount. Mm-hmm. And then the middle amount, you're getting taxed at a different amount. And then the real big chunk at the end, the larger amount, you're getting taxed at whatever that bracket that you're in.
Yes. And the reason why this is important is that some people, when they might have overtime or they might have extra money come in, bonuses, that kind of thing. And they might be worried it'll throw them into the next tax bracket. You might have heard that expression. Just knowing that it might throw you into that next tax bracket, but only a small percentage of that money will be being taxed at that anyway.
Yeah. So if let's just, for example, if you're making 75,000, the next tax bracket starts at 76,000. It doesn't. All right. I don't think it does. This is just for example. You're like, I can't work any overtime because if I get bumped to 76,000, right, I'm now going to have to pay 24% income tax on all my income. That's not the case.
That is true. That is not the case.
Okay.
So being aware of just how the tax bracket works is a very good thing to know. That's question 2. Question 3, should we even get a refund?
Okay, so refund obviously is a big popular thing when we're talking about taxes. This is typically the only thing people like about tax season is they get a refund off of it. So when we're asking, should I get a refund? Everybody as a whole all says at the same time, yes, right? Because we like getting money. But we're going to contradict that. And we're actually going to say, no, you should not get a refund. And you're going to say, well, why? That's free money. Right? At the end of the year, or not the end of the year, but at the end of the fiscal year, they're giving me money, right?
Yeah.
Why should I not get a refund? Well, it's pretty simple because the refund that you're getting is not free money that the government's giving you. What is the money that they're giving you, Kevin, when you get a refund?
It is your money.
It's your money.
Held on to.
Yeah. So when you get a tax refund, it's money that you've essentially, for just a simple explanation, it's money that you throughout the year have given to the government tax-free and interest-free for them to use however they want. And then at the end of the year, they're just giving it back to you without any interest. So if you get $2,000, right? All right, I think in 2022, the average refund was about $3,000, $3,200. If you get that $3,200 back at the end of the year, you're like, this is awesome. I got $3,200. But realistically, you should be thinking, oh man, I could have had $3,200 all year that I could have been doing other things with, right? So ideally, no, you should not get a tax refund. And that's because I don't, maybe you're a little bit different than me, but I don't want to be funding the government with the money that I'm working hard to have.
Yes.
Especially when they're not giving me any benefit, right? They're not giving me interest on that money.
No.
So ideally, don't get a tax refund. But let's be real. Most people are getting a tax refund.
Yes, they are. And what should we do with that, right? What should I do with my tax refund? Well, we've kind of thought of 3 things that you can do with it, that you should do with it. And if these 3 things are in place, then we're okay with doing some other stuff.
Yeah,
but
and this is question number 4.
Yes,
I just want to clarify.
Yes,
this is question number 4.
What should I do with my refund?
Because
question
most people
4.
are going to be getting a refund. Question number 3.
Yes.
So what should you do with the money when you get it back?
Yes. So establish an emergency fund. That's critical. That's the number one thing I would say. If you do not have an emergency fund already, use this money to start making one, right?
And how long, when we talk about emergency fund, just real quick, how would you define that?
I would say 3 to 6 months of expenses, of your household expenses.
Okay.
That would make me comfortable with your emergency fund.
And that's why having a budget, everybody, is important. So you know what that 3 to 6 months of expenses is.
Yes, go see our budgeting episode if you haven't already. And pay off debt. That's the next thing, right? Making sure you start with a credit card because it's the highest interest.
Correct.
And then car payments. Mortgage isn't really considered a debt here. We don't want to... I mean, you can throw your tax refund on your mortgage, but it's not something that you have to do.
Especially if you have a really low interest rate on your house, like a 3%, like everybody's getting a couple years ago. It's probably not long-term beneficial. There's other benefits you could do with that money instead of putting it on your mortgage.
Right. And then save for retirement. So this is more funding your IRAs or your 401ks, as the case may be. But if you are saving for retirement, you are debt-free other than your house, and you have an emergency fund, then feel free to take it and spend it on yourself. Do something you want to do.
Yeah.
Have fun with it.
And be a little goofy with it. You don't have to be responsible all the time with your money, as long as you're like making sure all your other boxes are checked.
Yes.
It's okay to go get a nice TV.
Yeah.
Like that might not be the most mature, responsible decision with your money, but like if you're doing a good job, like in the words of Parks and Rec, treat yourself.
Yes. For sure. Once again, don't feel bad about it. If you got your house in order and you're doing those three things, then that money can be for fun money. Also, just a quick disclaimer. Some people might have a hard time not getting at least a little bit of something for a refund if you have a child, because that child tax credit is kind of pretty high.
Yeah.
So just know that you could do everything and still possibly get a little bit of something, but just trying to make sure that it's,
I don't want to make you feel guilty if you're getting a tax refund. Like, it's okay. I was talking to my wife about this and she was like, but I like getting a tax refund. So like, it's okay. It's fine. It's not a big deal. It's just mathematically like,
yes,
you probably shouldn't be getting it, but it's okay if you do.
Yeah. Some other things that we wanted to consider. The biggest thing you can do to minimize your taxes for the upcoming year is to invest. Put your money into an HSA, which is a health savings account. And that's an account that can be used for anything health related. You can pay right out of it. And most places, if you have over $1,000 in it, you can invest it as well. Contribute to a 401k or IRA. Investment retirement account is what IRA stands for. And then doing all these will definitely reduce your taxable income for the next year. And it also helps you financially down the road as well.
Yeah. Long term, you're going to have money that's growing that's going to help you down the road. Just another final point. I was listening in preparation to this to a bunch of tax podcasts, which was probably one of the most boring things I've ever done in my life. Let's be honest. But it was some helpful information. I was doing research. All right, I suffered for the sake of research, and one of the points that they made that I thought was interesting that I hadn't really considered was wait to do your taxes. And the reason that they said wait to do your taxes is if you get your W-2 January 31st. They said don't just run out quick and do your taxes February 1st. There's nothing wrong with doing that, but the reason that they said to wait and take a step back and be a little patient is because there might be a 1099 specifically was the example that they gave that could come back as somebody gave you a document that was wrong, and you could go file your tax information, right, your tax documents, and get it all done, and then get a document a week later that has corrected information. And then you just filed your taxes wrong and you have to go through the whole process again. So they said, you're not getting any benefit from doing your taxes early unless you're getting a refund and you're just going to get the refund sooner. But really, you're not getting any benefit because you're still going to get the same refund.
Sure.
So waiting a couple weeks and just making sure that you have all the paperwork's correct, you're not missing anything, might just save you a headache down the road.
Yes, and we'd also like to say, if you have listened to this long on a tax podcast, we appreciate you.
Congratulations.
Congratulations, you should get a medal because taxes are the most boring thing that you could probably discuss. But I do hope that you took something away that you may not have known before and that you learned something. And we do look forward to seeing you on the next podcast. In the meantime, go on our website, financialfeastpod.com. Follow our Facebook. We do updates on we do blog updates. Zach will put some blogs out. He already put some new ones out recently, but that is constantly being uploaded and updated. So make sure you visit that. And we hope to see you next time on the Financial Feast Pod.